Hello guys, welcome back to my channel. It has been 2 weeks since I last posted a video on here. Today I have something new for you guys. So before I get into the lesson of today, I would like to announce that I have a new Telegram channel. I post free signals on there and A+ setups. Okay, so click the link in the description below to join the Telegram channel. Is for free. All right, there are a couple of people there already. You can join and have the free signals coming to you daily, and plus setups which you can actually copy and learn from how I trade. All right, and also I have a new website which you can actually visit. You can visit the website and you can find on there digital assets, okay, or digital products or materials, trading materials which are put together for you guys. And I have a new book, a new ebook which I put together for you guys. I've been working on it for months. And for those who want to learn how to trade, especially beginners and intermediate traders, you can actually get that book and read that book from the beginning to the end. It's actually a short book. You can complete it, and it's pretty concise and precise, all right, and comprehensive enough for those who are coming into the Forex market. This is my promise. By the time you finish that book and you have understood everything in that book, you'll be able to place your first trade on your way to be a profitable and professional trader. All right, guys, today we are going to be looking at types of market orders. All right, so let's go right into it. All right, guys, so we are going to be looking at types of market orders. All right, we are going to start with market order. Okay, what is a market order? A market order is a type of order which allows traders to buy or sell immediately at their current asset price. Say you are buying Euro USD, or you are selling Euro USD, okay, or any other asset in the market. When you place the order immediately at the current price, that is a market order, all right, whether you are buying or selling, all right. So that's what we call a market order. It's at the current running price, all right. Let's say the bullish market forming higher highs and higher lows in this fashion. Okay, and then you get to a resistance level. At that resistance, most traders actually are looking to sell. You place a sell order at the current running price. Okay, that becomes a sell market order at the current running price. Okay, so for an order to be a market order, it has to be executed at the current price in the market. So sell market order. Okay, this is a current price running in the market right here. Okay, and should you decide to sell, I mean to buy the same asset, you buy at the current market price. Say in an uptrend, like in this case, I will still use this example. If you are anticipating the price has broken above this level and you are looking at buying, all right, buying at that level, you'll be looking at buying at the current price, all right. So you place your buy order right there at the current price, your stop loss just below there, and continue the trend to the upside. Okay, so that would be a sell market order at the current price, and that would be buy market order. Okay, all these are at the current price. This is just an illustration. Okay, so that would be the market order. So moving on to the second type of order is a stop loss order, and the third one is a take profit order. I'm going to explain both of them at the same time. So just to go back to our illustration right here, okay, when we look at this illustration on a sell market order, we would place then our take profit down here. That is a take profit order. Basically what you are telling the broker is to close off your trade or your position at a profit at a set price in the future. Okay, should the price get to this point here or drop even lower to this level here. So you're looking at a take profit order at that point. When you set it there, the broker will automatically close your position in a profit. Stop loss order would be the opposite of the take profit order. Let's say you have placed your sell order and you don't want to lose so much money beyond a certain price. So you set your stop loss order just above the resistance there. So this would be a stop loss order. This is basically you telling the broker to exit your position at a loss when should the price go against you, all right, go against you and hit that particular price, okay, in the future. So a stop loss order would be the opposite of the take profit order. Take profit order, you are asking the broker to take you out of your position or to close the position at a profit in the future. And the stop loss order would be the opposite. You're asking the broker to take you out of your position or to close the position at a loss should the market go against you, okay, at a certain price. So you set all of that in the future. Now the fourth type of order is called a limit order, okay, and that is also divided into two. A limit order is a type of order which allows traders to buy or sell an asset at a set price in the future. So this is a price you set in the future to buy or sell. The trade will not be executed until the price falls or rises to a set price. Once it does, the trade is opened by the broker automatically, even when the trader is offline. This is for anticipated reversals at support or resistance levels. Okay, so let's begin with the first type of limit order. There is what we call a sell limit order. This order allows traders to sell at a set price in the future at either a resistance level or area of value, okay, and you're anticipating a reversal. In other words, they're anticipating a reversal to the downside at a major resistance area. This is triggered automatically even when the trader is offline. Just to illustrate here, let's say you are in an uptrend, okay, this price is rallying to the upside, okay, and it gets to a resistance level, okay, let's say this is a bullish trend, you get to a resistance level, let's say this is a resistance level right here, and you are anticipating this price to fall from here, okay, because it's a resistance, most traders are looking to sell here. So you set your price in the future where you anticipate a reversal, okay, you set the price in the future, instructing your broker as the price rises to the upside to sell, okay, to sell at a certain price, higher price in the future, because you are anticipating a reversal to the downside. So that is what we call a sell limit order. It is in the reverse of the current trend, because this is an uptrend, as you can see, but when it gets to resistance, you are anticipating a reversal to the downside. So as the current trend is running up, you are looking to sell at resistance. So you instruct your broker to sell at a certain higher price in the future around resistance, okay? That is what we call a sell limit order. You set it to happen in the future at a higher price, usually at resistance, okay? So you set it here and you instruct your broker to execute this order once it gets to a resistance level and at the area or at the price where you have set it to be sold at, okay? So you are anticipating, so when the price gets there to that price, okay, which you set, the broker will execute your sell position or open your sell position, okay, for a short to the downside. All right, because you are anticipating the price to fall lower to your take profit level. So you'd have to set your take profit here. I've already explained what take profit here means, okay? So your take profit will be right down here, and your stop loss will be somewhere up there, okay, right there. Okay, so this would be what you'd be anticipating. So this would be a sell limit order. Happens in the future, instructing the broker to to open a sell position at a higher price around resistance level, anticipating a reversal to the downside. Now, the other one is a buy limit order. This order allows traders to buy an asset at a set future price at a major support level, usually at a major support level. In this case, a trader is anticipating a reversal to the upside at a support area or demand area. This is triggered automatically even when the trader is offline. Let's say it's a downtrend. Market is forming lower lows and lower highs, okay? Lower low, lower high, lower low, lower high. And then it gets to a support area. Let's just say this is a support area around here. This is a support area. Anticipating that the price is, the trend is going to reverse to the upside, okay? When it gets here at support and at the demand zone. So you instruct your broker to buy or to open a buy position at a support area because you are anticipating a reversal to the upside. So that will be in the future. So you set that price. As the price is falling, you are telling your broker, when the price gets to this low point or this low price, I want you to buy because I'm anticipating a reversal to the upside. So you place your buy limit order. That's what it is, okay? As the trend is falling or as it's a downtrend, you are looking to buy at a support area. So you place a buy limit order. It's a reversal to the upside, okay? So you are buying when the price is falling at a certain lower price. So you instruct your broker to buy at a certain set price. You set your stop loss and take profit, and then you can wait for that to happen in the future. The broker will execute that automatically for you. Take your profit right there, and then your stop loss would be way down here below the support area, and you are anticipating that this price would rise, okay, to your take profit, okay? And you have already also set your stop loss. Should the price reverse against you to hit your stop loss, you have already set that, and you have instructed the broker to close your position should it hit the stop loss level, and you have instructed also your broker to take you out in profit should it hit your take profit price, okay? So this is a buy limit order, okay? This would be a buy limit order. It's just the opposite of the sell limit order. This is how it would look like. All right. So let us move on to the other type of orders. And now the fifth type of order is called a stop order. Okay. So don't confuse this with a stop loss. It's just simply called a stop order. Okay. And it's divided into two. This type of the stop order is a type of order which allows traders to buy or sell an asset at a set price in the future. So this one is also executed in the future by your broker. So all you have to do is to set the limits, okay? So this is an order you give to your broker to buy or sell. This is for continuation of the trend. So the trade will not be executed until the price falls or rises to the set price. Once this happens, the trade is opened by the broker automatically, even when the trader is offline. This is for anticipated continuation of either a bullish or bearish trend. So that's the difference. With a sell limit and buy limit, it is a reversal, okay? But with a sell stop and buy stop, it is a continuation of the trend. We are going to start with an uptrend, okay? This is a buy stop order. So buy stop order, you are anticipating the price to continue higher. Just an illustration here. So let's say this is a resistance level and you have these higher highs and higher lows being formed, and the price blows above resistance, okay? And there is that retest there that has happened, all right? So this is in an uptrend, okay? And you are anticipating this trend to continue. You are looking at a continuation of this trend. So you place a buy stop order at a future price telling your broker to execute a buy order to continue that trend to the upside. All right, so that would be a buy stop order. So you execute it right here at the at a set price in the future. So that would be a buy stop order. Okay, so this is in the future. This price has not yet, the market has not risen to this price yet. Okay, it's just rising from this level. But then you instruct your broker to buy at a later price in the future. Okay, to continue the trend to the upside. So you place that order, okay, anticipating the price to rise even higher. Okay, even higher. All right, so this would be a buy stop order to continue that trend to the upside. This is what you are anticipating. You are hoping this price continues to rally to the upside to your TP or take profit level up here for take profit, and SL for stop loss. You'll have set your stop loss just below here, okay, below the previous resistance, which has now turned to support, because this is a continuation of the trend. So this would be a buy stop order to continue that trend. Right, so a sell stop order would be the opposite of the buy stop order. A sell stop order, you are just anticipating, let's say the market is falling to the downside. You have lower lows and lower highs, okay, and it blows beyond support. And after the retest of the support, you are looking to continue that trend to the downside, okay. You are anticipating this, the selling pressure is so strong, it will continue dropping, okay. So you put a short order in the future. You instruct your broker to open a sell position, okay, below the support right here, because you're anticipating that the price will blow beyond support. Okay, so when that happens in the future, even when you are not online, your broker will open a sell position. So that would be a sell stop order, okay, to continue the trend. So you place your sell stop order right there. Place your stop loss just above the previous support, which has now turned to resistance because the price is falling, and then you target the price to even drop lower. So you place your stop loss just above the previous support there, which has turned to resistance, and then you place your TP or take profit down here, anticipating the price to fall even further down to this TP point. Okay, so this would be a sell stop order, the opposite of a buy stop order. Okay, so this would be, okay, so all this you set in to happen in the future price. Okay, when the price drops even further to your set price, that would be a sell stop order to continue that downtrend. When the price rises, like in this illustration, beyond resistance and continues even up, okay, beyond your set price, that would be a buy stop order, okay, to continue that trend to the upside. So these are the types of orders you have to master as a trader to know how to actually take advantage. It becomes easy for you. The advantage of these types of orders, except the market order where you have to manually execute the order or open a position, these other types of orders you can actually set and move away. Your phone or your laptop or your desktop, you can just move away after setting that order, and then these orders will be executed automatically by your broker. And it also helps with risk management and your psychology, because you don't want to watch the charts and the candles dancing. They may prompt you to close the order and yet and then regret later when it would have gone in your favor. All right. So these orders are really good, and they help with risk management because you set your stop loss and take profit also when you set these orders, and the broker does it all for you. And all you have to do is to check later to see how that went. All right, so these are the types of orders. Please, if you haven't understood, go back and rewatch this video from the beginning. All right, there you have it. Thank you for watching this video till the end. Like this video if you have found value in it, and also if you haven't subscribed, consider hitting that subscribe button. It only takes a second. Thank you for watching. Until next time, bye bye.